when people say infinite banking is for the wealthy, it's not for the wealthy. It's for the wealthy in character, for the people who are capable of multiplying the talents that they've been given. If it's 1 or if it's 5 or if it's 10, if you have the character to multiply, then start where you're at. Don't wait until you have 5 talents or until you're given 5 talents to start multiplying. Start when you're given 1. Today we're talking about creating your own banking system through dividend-paying life insurance. We're hoping to cover pages 21 through 25 or 27, whatever it is, of becoming your own banker. But there's so much meat in these pages that everything else kind of comes back on that we might not get that far, and we don't want to take 3 hours of your time on one podcast episode. So, bear with us. One of the things that Nelson was and emphasized a lot was he was a Christian, and he emphasized his faith a ton. And there's Bible quotes throughout this entire book, and that's one of the things I really liked about Nelson. He talks about Matthew 25 in this one at the beginning. He says, to quote it, he says, "You should have put my money on deposit with the bankers so that when I returned, I would have received it back with interest." What this is referring to is the parable of the talents in Matthew 25. And what happened, I'm just going to kind of read the beginning of that. He says, "For the kingdom of heaven is like a man traveling to a far country who called his own servants and delivered his goods to them. And to one he gave 5 talents, to another 2, and to another 1, to each according to his own ability. And immediately he went on a journey." And then it goes on to discuss how those 3 servants took the talents that the master gave them and either multiplied them or did not multiply them. The one who was given 5 multiplied them to be 10. And then the one who was given 2 multiplied them to be 4. The one who was given 1 did not multiply it. He buried it in the ground so that he wouldn't lose it. And this really comes down to a couple different things. One is an abundant mindset. The ones that were given more, they had a mentality of abundance and said, we're going to go do something great with this. And the one who was given 1 had that mentality of scarcity. And he was fearful that he would mishandle the master's money. And because of that, he didn't do anything. And he also didn't want his master to reap where he didn't sow. He called it. So it was just very interesting. One of the things that I find a lot of hope in that is weird, I guess, because I didn't before, was that he says each man, to each according to his own ability. He didn't give the man who was, he didn't give 5 talents to a man who wasn't worthy of getting 5 talents. And he didn't give the man who was, he gave everyone according to what they could handle. For me, what I love is that every man, no matter what they can handle, every man is given the same opportunity. And that is to increase the master's talents. They weren't their talents, right? They were the master's talents. And they were all given the opportunity to increase the talents. But they all had different abilities within that. Some were given more, some were given less. For me, coming out of a blue-collar, a little bit scarcity mindset type of financial childhood background, whatever you want to call it, it was encouraging to know that as I become more and more equipped, I will be getting more and more to multiply. I had to ask myself this question: if I haven't been given much to multiply, could that be because I don't have the ability to handle it? And after a lot of reflection, I had to answer yes, absolutely. It's because I do not have the character, the means, the conviction, whatever it might be, to multiply those talents. And I'll tell you right now, I'm grateful that I haven't been given a lot in the past, because if I don't have the character to handle it and then I'm given it, that's not good when the master comes back, because then I may have squandered it, probably would have squandered it, right? So all of this coming back to, like, when people say infinite banking is for the wealthy, it's not for the wealthy. It's for the wealthy in character, for the people who are capable of multiplying the talents that they've been given. If it's 1 or if it's 5 or if it's 10, if you have the character to multiply, then start where you're at. Don't wait until you have 5 talents or until you're given 5 talents to start multiplying. Start when you're given 1.
Wow. That's excellent, Kyle. That's a wonderful way to look at it. That we're all growing, whether we realize it or not.
Mm-hmm. And then in Matthew 25:27, going back to the quote at the end, the servant who had 1 talent, he buried it. And what he told that servant was, you should have put my money on deposit with the bankers, so that when I returned, I would have received it back with interest. I love infinite banking, because just putting money in these things, you're creating a banking system that you own and control, that you get the dividends on, that you get growth on as the owner of that. And so the very least that we can do, according to this verse, is put our money in a spot where it's growing at interest. If we're not capable of multiplying it ourselves, at least put it in a vehicle that is guaranteed to grow that. And that's what dividend paying life insurance with the right company is. It's amazing. And
Yeah.
so by participating in this process of banking through these vehicles, we are fulfilling part of the commandment within the Bible. And that
Yeah.
is good to know.
Yeah. Well, it can strengthen our faith. You can start, as you pointed out, you can start where you are and change the course of history, I guess you could say, in your family, through in the financial world. And the other thing that popped out when you were talking about that was that there's all kinds of wealth, right? This is just, capital is just one of them. And I wouldn't necessarily say that it's the most important either. It's, the things that we pass on, our ideas and our philosophies and our disciplines and all that, have huge value long term.
Yeah.
But this area of starting where you are and growing that character, as you had said, and the discipline, and if you can have that faith, so it grows your faith too. While you're doing that, it's growing your faith in God, and you'll. I think you'll end up being. I think we will be astonished as time goes on, and even in our own lives, as to what happens to this growth when you get into the 6th, 7th, 8th year, and you start to really see it just taking off. It's almost like that plane analogy that Nelson talks about in the book, that you fill it up with fuel. And so when you first take off, the efficiency of the plane isn't as good as it will be at the end, when there's not as much fuel and it's still running. The engines are still as powerful. It just takes off like a jet, but it's getting past those first number of years that it's a mind shift to get away from thinking that everything is short-term gains. We got to go after the fastest money. And everything that you and I have probably read, I can certainly speak for myself, the thing that I keep coming back to people that are way smarter than me about this and have spent their lives studying it. It's the combination of compound interest over the most important thing is time is phenomenal. Anyway, I think maybe I'm getting a little off track, but
No, you're good, man. That is great stuff. What you mentioned about the airplane is exactly the same thing. You can't just start with a lower amount of fuel so that you're more efficient, right? You have to start with that high amount of fuel in the plane in order to get it off the ground, in order to get to where you're going. And there's just it's naturally less efficient than when there's less fuel in the tank, and you're closer to your destination. Of course, it's going to be better. I think we want that future to be our present day, and if we don't get it, then we throw up our hands and say, well, it's not even worth doing anyways then.
Right. Yeah. Yeah, you have to start off with I'll call it a full tank, and stretch yourself to put in, I'll say, just put in that little extra that is almost a little like, I don't know if I want to do this,
Mm-hmm.
It's too much, but that little extra push is your full tank that you're taking off with. And probably in a short period of time, most people that are working are getting raises throughout their career, and eventually that amount of money really won't be that much of a stretch. So,
well, and especially if you're using infinite banking as it should be used, which is to create cash flow.
right.
I was considering what I would prefer if I was to take $100,000 and throw it into a mutual fund or an investment of some sort, and I was to get back 15% on that. That'd be 15,000 across the year. That's great, but I can't touch that 100,000 or else I wouldn't get 15%. So really, all you're doing is getting an extra little income of $15,000. What if you could put your investment into something that grows at 5% and you still had access to 60% of that? Let's just say you throw 100,000 in, your growth would be 5%, right? So $5,000 instead of 15,000, but you could access 60,000 of that to go create cash flow somewhere else. Which one would you prefer? Having an extra income or cash flow of $15,000 when you can't touch your 100,000, or an extra income or cash flow of 5,000 when you can touch 60%, $60,000 of that?
Yeah. Personally, I would go for the 60,000 that I could touch, because the 15,000, if you can't touch it, what good is it?
Yeah,
it's yeah, I mean, yeah, it seems, no offense to anyone, but it seems like a no-brainer.
It does seem like a no-brainer. Here's the problem. If you're somebody who doesn't have the understanding, the knowledge, the resources to take 60,000 and go do something profitable with that, that's where you run into problems.
Yeah. You have to qualify it. Taking the 60,000 for what?
Yeah.
Is it to fix something up in your house, or is it an investment that you know something about? We're running around putting money in these other things, these other vehicles that we really know very little about.
Right.
Yeah, even some things that I know about, I still question. Like there's a group that I'm attached to that are investors in real estate, and they end up collateralizing the property. And so they're first in line. Like if the builder defaults or whatever, they end up being first in line to be able to sell the property. They actually take the deed. They own the property for a very short period of time to protect themselves. And even that in this environment, I mean, I know there's a big shortage of housing, but I still question when the second shoe is going to drop, here
Yeah.
in this place. So I don't know. Anyway,
Yeah.
yeah.
Well, one of the things that he mentioned that I want to touch on, and then I would love to get your thoughts on the EVA. But he says the very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest that you otherwise could have earned.
Yep. Yep. That's
Foundational.
well, it's certainly foundational if you're going to take on this concept and use it. To be able to wrap your brain around that. And even if you're not going to hear that statement, you have to, at least for myself, I had to think about that for a while. Okay, yeah, I get that. Opportunity costs, but I need this thing right now. I can't be fooling around with thinking about all this other stuff. I need this thing right now. But there's a thing further in on these pages. He talks about EVA, or economic value added, and really that's what this statement to me is talking about also.
Okay.
That you pay interest, or you give it up, one or the other. And when you're inside of this policy, and he talks about recapturing the interest, really what he's talking about is EVA, in that you're going to charge yourself a higher interest rate because this is economic value added. It's those little pennies that you might, or nickels or quarters or whatever it is, extra that you're paying into, is the engine that drives the whole thing to explode. So it's goes back to the grocery store. If you're going out the back door, you got one grocery store going out the back door and somebody else going out through the front door. When they go to sell that, or when they're building the equity inside of that grocery store, which one is going to be more powerful? Well, the one that goes out through the front door. Because they're building the equity inside of the product or the tool, in this case, whole life, that is going to explode down the road just from doing that little extra. But yeah, I have people, and you probably have people say, well, I just pay cash for everything. Well, so it's opportunity cost. EVA is considered opportunity cost. And granted, like we just said, the only time that you're going to actually take money and invest it is in something that you know something about.
Well, ideally.
Yeah, ideally.
Isn't that one method that seems to be keeping a lot of people where they're at, is they don't feel like they know much about investments. They're not smart enough to do this, so they'd rather just give their money over to somebody who is smart enough.
Or at least perceived as being smart enough.
Yeah.
No offense.
Right.
Really. No offense.
Hey, that goes back to the richest man in Babylon. When he gave when he gave the money to the merchant and said, "Bring back jewels for me to sell." Well, the merchant wasn't a jeweler. He gave it to, no, it was a bricklayer. I think he gave it to a bricklayer who was going across seas, said, "Buy jewels when you're over there and bring them back." Well, the bricklayer had no idea what he was looking for, and he brought back glass that looked like jewels instead of real jewels, and then the guy wasn't able to sell them. How many times does that happen in our world, where we give money over to somebody who tells us that they can handle our money, or who seems like they should be able to handle our money because they were a very profitable and successful bricklayer? Of course they'd be able to handle our money. Well, if we're asking them to go out of their lane, or if we are trusting them to do something that's beyond their own experience, then that's really not putting our resources in the right place for them to be multiplied. We got to know what we're doing. We got to talk to the merchant who knows something about jewels if we want a good deal on jewels. We shouldn't be talking to the bricklayer. So again, I guess shameless plug here. This is why you go to the Nelson Nash Institute and find practitioners who have gone through this process when you're looking at starting to become your own banker. Find the right people who have been trained the right way, who have been practicing it in their own lives and have been profitable with it. That's who you should be talking to if you want to do this efficiently in your own life.
Right. Yeah. Yeah. And generally speaking, these kinds of practitioners, in my opinion, are people that are more open-minded. They're very curious about things. It's just natural for them to be digging. And that's how they found their way to this in the first place, is that they were digging and it just popped up, so to speak. We all kind of stumble on this in one way or another. But yeah, that's all really great stuff.
One of the things he mentions a little bit lower in that same column there on the first page, he was saying how many corporations, and it sounds like individuals, were borrowing capital from banks and paying interest, but they were treating their own capital or their own equity as if it had no cost. And I've been there. I've done the same exact thing. I've had capital in my own banking system. I've treated it like it had no cost. I've had dollars in my own bank account before I was aware of infinite banking. I treated them like they had no cost. There was just dollars in the account that were there for me to use when I wanted to use them. But then when I go out and get a loan from the bank, I'm willing to pay them an exorbitant amount of interest to access that money. I am way overvaluing other people's money than I am valuing my own money. That's where a lot of the problem happens. If we were to value our own money as much, or let's just say more, because we're the ones that earned it, than someone else's money, wouldn't we pay ourselves interest to use our money?
Yeah, and all of that goes back down to the EVA, economic value added, is figuring out, okay, if the bank's money is worth 5%, is ours worth 10? Do we love and care for ourselves and our families? Because this is a fuel for the engine that runs our family, on a monetary level.
Mm-hmm.
So what else do we have? The same applies. It begins with, so, and the thing about them, he gets into talking about the engineering of these products, that they overbuild them in such a way that at the end of each year, there is a little bit of extra money left over, and they call it a dividend, and they send it back to the policy owner, and that grows uninterrupted, especially if you're continuing to put it in as PUA, putting it back and buying more additional death benefit. Quite honestly, I don't know where I'm going with that, Kyle.
You're good. The one of the things that he mentions down towards the end of page 21 is that it's easy for us to forget about this. The contract with a dividend-paying whole life company, that life insurance contract, is a unilateral contract. They don't get to make changes. We get to make changes, the owners. When you sign that contract, you're creating something that didn't previously exist. You own it. You fund it. You own it. You control it. And as long as you fund it, they are obligated to fulfill their side of it, which is making the death benefits or paying the death benefits. But that position of ownership is really foreign to a lot of people, even successful people. Like, I think that a lot of, and when I say successful people, I'm just saying people that are relatively well off. a lot of us are very used to borrowing other people's money and leveraging other things. We're not used to what it really means to have complete ownership of something. We always talk about owning our own home. You default on a couple of those payments, guess what you don't have anymore?
Mm,
Your own home.
right.
You know,
Yeah.
it's crazy. So this is something that you truly do own and you control, and you get to say where the capital is sent and what the capital does, right? You get to determine if you want to borrow it or if you don't want to borrow it.
Right. Yeah. And then it also, so if you are going to borrow it, it borrows some of that equity that you've built up inside of the policy. When you borrow it, again, you know, I've said this in the past, you want to know how you're going to pay it back, because
Hmm.
that's the treatment of this asset. How you treat it has huge ramifications. If you treat it poorly, meaning you don't pay your loans back, or you know, you just keep taking loans, and you're still sending your premiums, so your cash value is getting depleted, but it's continuing to grow also because you keep sending premiums. But how you treat it is hugely important, and the treatment is taking care of it by paying back loans, so that it becomes more robust in the years ahead. Um, and you know, you stay completely in control forever. The only thing that you're obligated to do is send that premium, and you can change that too. As to, you know, after a number of years, you can change that too. But they can't change anything, you know, basically, as opposed to other products that people might use for this concept, which I won't get into here. But
Yeah, and just to make sure that folks understand, when you say you can change that too, regarding your premiums, you can decrease your premiums. Generally speaking, you can't increase your premiums. Um, but even within that, there is depending on the contract that you have, if you're already practicing, if you're coming from another practitioner, there may be some negative implications to decreasing how much you're funding. One of the negative implications is that you're not going to be building up as much capital in the future. But regardless, you're not stuck at, let's just say it's 100,000 a year that you're putting into a policy. If that's the case, then you're not necessarily promising to pay 100,000 until the day you die,
right,
right? And so
right,
that's one of the things that people generally get a little bit nervous about, is that it's a whole life policy. I don't want to commit to X amount of dollars for the rest of my life. Well, let's just get away from the fact that that's a scarcity mindset anyways. But even then, like you can't put in 100,000 until you're 100 years old or 110 years old. You just can't. The policies won't accept it. So I think that's kind of what you were referring to, right, Raymond?
yes, yes. It's not like you can put in more above what we started out with, but you can lower it. Yeah, exactly. Yep. Um, so I have a question I'd like to ask you, just to bring some clarity to this statement. And I'll say the statement, and then I'll go back and kind of give it some context inside this one paragraph. And that is the comment of, this is on page 22 on the second column, about halfway down. There is an ever decreasing net amount of risk for the company. And what they're referring to, that is the insurance company. And so, to get more context, the policy is engineered to become more efficient every year, no matter what happens. That is, if the owner does what is called for in the premium paying loan repayments, interest plus interest. Thereupon, that there, let's see, thereon that are at least equal to or better than the general investment portfolio of the company. That is because the cash value is guaranteed to ultimately reach the face amount of the policy by age 100 of the insured. And then that statement. there is an ever decreasing net amount of risk for the company. Can you explain why there is a ever decreasing risk?
Yeah, just because when you are making payments and moving through time, you have less payments to make in the future. So they're telling you you should die, let's just say, at age 92 with your health and everything. That's where the life insurance company assumes that you're going to die.
Hmm.
If you have an accident at age 72 and you then they have to pay that death benefit earlier, right? They're still paying that same amount of death benefit whether you die at 92 or 72. They're still paying that same amount of death benefit. Well, if you've only made payments for a few years instead of a lot of years, then they received less money from you to go out and multiply to become profitable and pay that death benefit. Does that make sense?
Yeah. Yeah.
So as
Yeah.
you go through time and make more payments, they've received more from you. They've grown that money because they're responsible stewards of money. They have grown that money. And therefore, the balance between what they've grown, what they've received from you and what they've grown, and how much they owe you upon death is always shrinking.
Because of time, because you're getting closer to death.
And because they are making more money with the money that you've given them, and you've given them more money.
Yeah.
It's kind of the whole combination.
So as he goes on to the next paragraph, he just says, not too many people are familiar with the concept of getting better no matter what. And that's really what that's talking about.
What have you seen get better no matter what in your life, Raymond?
Whole life dividend paying life insurance. That's it.
That's it?
Well, I shouldn't say that. I mean, I have to say that for me, marriage has gotten better.
That's good. That's awesome.
Yeah, yeah. But this also lends this concept of getting better is go back to our part where we were talking about the jet taking off, you know, full fuel, and then when it's almost at its destination, it just becomes more efficient. Yeah. So I just to jump track here a little bit, I just it pertains to this, but I just attended a dental show in Iowa City a week and a half ago, and on the new banner, I had a new banner made up, and on it, there were a bunch of different words, but on it, there were the words guaranteed and certainty. And I used those two words. It was in a phrase, but I used those two words. I would point them out. And I said, you see these two words. I don't know if you'll ever see these anywhere else, but this is guaranteed and it has certainty. And I said, this word guaranteed, do you see that anywhere out in the financial world that you're investing in? No. And I said, well, you won't. The reason that they can say guaranteed is because by law, they're going to pay upon your guaranteed death.
Mm-hmm.
So, yeah, anyway.
And by contract, their cash value, the net present value of that future death benefit, must always increase as you get older. Just because, time,
just because
contract, law. It's so cool.
Yeah.
I had a client actually reach out to me last week and ask, where does the life insurance company invest their money? Because I want to make sure that if the money that I'm putting into a life insurance company is going to actually build a world that I want to live in, right? And kind of implying that there are financial companies that are putting money into places that are yielding profits but are maybe immoral, if you see what I mean. And so this section over here talks about that when he says that money can be lent to, well, I'm just going to read it. The owner outranks every potential borrower in access to the money that can be lent. What he can borrow is 100% of his equity in the contract, which is the amount that the company can lend at any one time. They're not doing fractional reserve banking or anything like that. So if this is true, which it is, then what this amounts to is absolute control over the investment function of the company, which you partly own, as it relates to the owner's policy. In essence, money can be lent to the other places only if the owner of the policy does not exercise his option to use the money and pay interest instead. So I pointed him back to this and said, hey, you are the one that the life insurance company is going to invest in if you choose to, right? And if you neglect that right and say go invest in other people, then fine, that's totally fine. But what other place can you put money in and then be able to leverage that money that you put in, leverage that capital to go create a world that you want to live in? You can't do that anywhere else. It's here in the dividend-paying whole life. That's where it exists.
Yeah.
That's cool.
Yeah, that is cool. So to play devil's advocate here, but would he sounds like to me like he was referring to what is the company investing in other than him? Maybe you already understood what you just explained, but are they investing in things that pollute, or do they destroy habitats and all that? That's probably really what he was probably referring to, don't you think?
It is what he was referring to, and I get that. That's where generally we're all coming from when we're thinking about, do I invest my money into X company? Well, they do some evil stuff, so I'm not going to invest in them even though they're doubling their money all the time. I get that, but we're always dealing with humans. We're always dealing with, there's going to be, you look at the ledger of anything out there, and there's going to be something that within that ledger, and I'm talking like financial companies, I'm not talking like really small, tiny Christian organizations or something like that, but I'm talking actual financial companies. If you really dive into every single element of the entire ledger, you're going to see things that you just doesn't resonate with you.
Yeah.
Don't let that be what stops you from putting money into something where they'll actually invest back into you.
Right. Yeah. And here's my thoughts on that is that in order to change the world that you want to see, you have to become that yourself first.
Right.
What do they say? Be the change you want to see.
Thank you for joining us on the Sound Banking Podcast. If you're listening on YouTube, make sure to like and subscribe and click on the notification bell. Otherwise, join us on Apple Podcasts and Spotify for more content.